Now, chapter 5, we're going to take all of the information that we have learned up through chapter 4, and we're going to use those exact same entries, those exact same consolidating entries, but now we don't own 100% of the subsidiary company for the parent. So what we have is that we might own 50% or 60%, but there is another 50 or 40 or 30% stockholders out there who still have an interest in that subsidiary company. And this is by and far the most common way, because rarely can a company get all 100% of the stock outstanding. So there are going to be what we call non-controlling interests. And we will abbreviate those non-controlling interests NCI. And they will have a line item. There'll be a line item representing the NCI's share of the net income. And then there'll be a line item on the balance sheet that represents their share in everything. So the equity, all the acquisition accounting premium assets, their share of the income, their share of the dividends, all of those will net down into that line item in the equity section. So now what you want to remember though, we will still have this, we still put in 100% of the sub's assets and liabilities. We still put in 100% of the sub's acquisition accounting premium assets. Where we offset it is just strictly in that stockholders equity section in a line called the non-controlling interest, so that NCI. But everything else goes in 100% because sometimes students want to try to take it at 80% or whatever we own, and that's not how it works. All's going to go in the same way it always does. We just add that line item. And the same thing with the revenues and expenses. They're going to still go in at 100%. But when we get down to the very bottom, we're going to split it and say, okay, this is the share that goes to the NCI, and this is the share that goes to the parent. So that's all we do. Now, goodwill, this gets a little bit, they give you some different stuff here in the book. But to be honest, it's really normally the problems that we do, it's going to be at whatever percent we have. Like if we own them 80%, that goodwill is going to get split that same way, 80-20. But they give you some different scenarios where it could be a little bit different than that. But I don't think any of the problems that I assign go down that road. Okay, so then now this is the difference. So look at these entries. We've already studied and hopefully completely understand the E and the A. We started the E and the A in chapter 2. We had them in chapter 3. We had them in chapter 4. So, I mean, hopefully by chapter 5, you should have these entries down pat. So E is eliminating the sub's equity. So our beginning of the year retained earnings, the common stock, and the paid-in capital of the sub. Now then, so those are 100%. Those are the same way we've always done them. We pick them right up off of their balance sheet and their statement of retained earnings, whole amount. Then we come over to the credit side. Excuse me. And this is where we say, okay, we don't own them 100%. So 80% of that equity is in the equity investment. 20% of that equity is in our non-controlling interest. So that represents the non-controlling interest in the stock of the subsidiary company. Then we come down to our acquisition accounting premiums. These are all going to be entered at 100%. So 100% of the property, plant, and equipment, 100% of the patent, 100% of goodwill. But then this is where we recognize we don't own them 100%. So in our credit, we say, okay, the parent has 80% and then the NCI has 20. So again, we take our total acquisition accounting premiums times 80% to the parents times 20% to that NCI. Then we get into what about our income? So then now our income, the parent is only going to be entitled or get to record 80% of the sub's net income. They also are only going to receive 80% of the dividends. And the amortization of those acquisition accounting premium assets or the depreciation, they only get 80% of those. So then the equity investment will be adjusted then for that percentage. Then notice the NCI gets their share. They get their share of the amortization. they get their share of the profit, and they get their share of the dividends. So then here are all of the entries. So what's highlighted are the changes. So the E and the A to me are the easiest. The D doesn't change at all. So that just is what it is. The E and the A, the debits are all the same as they've always been. It's just our credits. Now we split between the parent to go into equity investment, and then the NCI go into the NCI. This one's a little bit more complex, the C entry. So I kind of map it out. Like, we know we're going to look at the income statement and we're going to see the parent's equity income. So we know we have to eliminate all of that. We know we have to eliminate all of the dividends. Then we want to go through and say, okay, what they show down here, this bottom one is the net incomes, the NCI's share of the subs net income less their share of the dividends. That's going to be a credit into our non-controlling interest. This $34,000 up here is the actual share the NCI gets in the subs net income. And that $34,000 is going to be a new line item on our income statement. So then those two that are yellow are a little bit harder to maybe get your mind around. But then just kind of understand what each of them means, and then we'll work them out in the problems. So then here you can see what I'm talking about. So we have a new line item that's highlighted here, consolidated net income attributable to the NCI for $34,000. We subtract that out of our total, and then this is the consolidated income to the parent, and then notice that number equals the parent's. So not the number before it, but the number after they share with the NCI. And then again, these are like, those entries are all still the same. These are all still the same. Then you come down to the very bottom and we have our new line item called the non-controlling interest. And we have those three components going into it, the E, the A, and the C for the NCI's applicable percentages of each one of those. Okay, then let's see. This again is just showing you that net income in a little more detail, same thing that we had. And then it's showing you kind of how we map it out into the retained earnings. Now this is where it gets a little bit confusing. So, and this is what you do kind of want to understand though in this chapter as well. When we have intercompany sales, so we could have intercompany property, plant, and equipment type sales. We could have the intercompany inventory sales. Well, then now when they are upstream, when the sub is selling up to the parent, we'll have to like record these entries a little bit different than we do if it's downstream, the parent selling to the sub. So they give us the same information like they gave us in chapter 4. We've got our intercompany sales, our profit, how much is left in our ending inventory, and what's the receivable between the two. So when we come down here, it's trying to help us reconcile out the subsidiary's net income. So we start with the subsidiary's net income. We now get to recognize the profit that was deferred last year that's in our beginning inventory, the $17,500. We are going to adjust it for the profit that's left in our ending inventory, so we have to subtract that. So we add the beginning, subtract the ending, subtract our depreciation and amortization, and then we split. So that is when it's upstream though, the sub selling to the parent. So then the NCI shares in all of those adjustments. So then we come down and say we have $159,500, 80% goes to the parent, 20% goes to the NCI, really. Yeah, so sorry, this, I think that's a typo on their part. That should say the NCI, not the subsidiary. Okay, then here's our consolidated worksheet. So now you can see, again, we still have the consolidated net income attributable to the NCI. So the 31,900, which is that number there. So again, like I said, that really should say NCI. Okay, Then the rest of the entries are the same. Now look at our I entries. So our I sale is the same as it was in chapter 4. Eliminate the total intercompany sales against the cost of goods sold. Our beginning inventory adjustment credits our cost of goods sold, and our ending inventory adjustment debits cost of goods sold. Our ending inventory adjustment is reducing our inventory to bring it down to cost. But then now notice our beginning. So at the beginning is a credit of $17,500 to cost of goods sold, but that's going to be split between the equity investment and then the NCI, because the parent is only going to record their 80% of that, and then the rest of it's going to go down into the NCI. So then that's the only one of those entries that is a little bit different, and that you do have to split it between the equity investment and the NCI. Our intercompany payable to receivable is the same. We just eliminate that completely. So again, this gives you the steps. And there's certain steps that I always like to do. So, I mean, I like to understand what's in that, excuse me, equity income. I want to understand what's in the equity investment, because those are two things that I know I have to eliminate. Obviously, I have to know what's in the acquisition accounting premium so that I know how much to depreciate. But then I look through my equity income, my equity investment. I don't necessarily like reconstruct that T account, but if that helped you to understand it. And then I'm gonna split it though then between the NCI and the parent when I do them on the board. Okay, so you do want to understand those, and let me go back. They can also have an intercompany sale of like property, plant, and equipment. And again, if it's upstream or downstream, that's going to impact those as well. So we don't have an example of that in the PowerPoint, but that can happen.